Welcome. In this video, XCN 500% bullish wave is coming. What is the reason? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
The concept of an uptrend is one of the most fundamental and powerful technical analysis tools for understanding price movements in financial markets and predicting possible future scenarios. If an asset's price consistently makes higher lows and higher highs over a given period, it indicates that the asset is in an uptrend. In other words, the market is generally under the control of buyers and the price direction is upward. An uptrend is critically important for investors to identify buying opportunities, determine when to open positions, and understand whether the trend will continue. In the situation you described, the price is currently touching this uptrend. This touch point is a highly important area in technical analysis because the trend line often acts as a strong support zone. A support zone is a level that halts a downward move and where buyers step in. The uptrend line is drawn underneath the price movement, typically by connecting certain low points. Each time the price approaches or touches this line, a large portion of market participants see it as a buying opportunity. The logic behind this is quite straightforward. As long as the lower boundary of the uptrend is not broken, the trend remains intact. If the price bounces from this line and turns upward again, the uptrend continues. That's why moments of contact with the trend line are often areas where high-volume buying takes place. Especially experienced investors and algorithmic trading systems closely monitor these trend lines because they represent strategic entry points where risk is relatively low and potential reward is high. The fact that the price is currently touching the trend line brings two main possibilities for investors. The first possibility is that the price bounces strongly from here and starts a new upward wave. This is the clear sign that the trend is continuing healthily. The second possibility is that the price breaks below the trend line, which could signal the potential breakdown of the uptrend. Therefore, these contact points carry both opportunity and risk. Another point to consider here is the nature of the contact. Is the price approaching the trend line through a slow, gradual move, or is it coming in sharply? If the price approaches slowly with declining volume, it's generally interpreted as a healthy pullback with a high likelihood of bouncing upward from the line. However, if the price reaches the trend line through a sharp, high-volume sell-off, the risk of a breakdown increases. From a market psychology perspective, a price touching an uptrend line typically draws investors' attention, especially if the trend has been monitored for a long time. This contact is almost seen as the next buying opportunity. Buyers tend to open positions at this point, and sellers may ease their selling pressure. This dynamic makes it easier for the price to react upward. Looking at past price movements, it can be observed that many assets have seen significant rises after touching their trend line. For this reason, technical traders often project that as long as the trend line remains intact, the price could move to higher levels in the medium to long term. In the cryptocurrency market in particular, such touches can be the starting point of sudden and powerful rallies since both retail and institutional traders place high importance on technical levels. For example, let's say the price is at $0.015 and the uptrend line passes through this level. If buyers step in when the price falls here, a quick bounce to the $0.018 to $0.20 range can occur. Such a move would show that the trend is still intact and would increase market confidence. With that confidence, investors could make larger purchases and the price could gain further momentum. Another important aspect when the price touches the trend line is how many times this has happened before. If it's the first or second touch, the support is usually stronger. However, if there have been many touches, each one slightly weakens the line and increases the chance of a breakdown. That's why investors should analyze both the number of touches and the price's reaction after each one. In conclusion, a price touching an uptrend line is a highly critical situation in technical analysis. This point is both a potential buying opportunity and a test of the trend's strength. If the price bounces from here and begins making new highs, the uptrend is confirmed as healthy. But if the trend line is broken, different scenarios come into play, and investors must develop new strategies. Investors who correctly analyze these contact points can capture opportunities with low risk and high potential reward. Especially when combined with disciplined risk management, uptrends can provide significant long-term returns. Therefore, the price's current position and its distance from the trend line are among the most important elements to watch in market tracking. If you like, at this point I can create a detailed trading plan to determine the potential movement after such a contact. This plan can include both risk management and possible target levels. But we can't decide solely based on trends. Let's also take a look at other metrics. Stay tuned.
The MACD,
Moving Average Convergence Divergence Indicator is one of the most commonly used tools in technical analysis to understand the momentum of price movements, trend direction, and potential reversal points. This indicator measures the relationship between two moving averages, giving investors the ability to identify potential buying or selling opportunities in the market. In the scenario you mentioned, if an upward crossover occurs in the MACD, it is predicted that the price will rise. This observation is based on a strong foundation both technically and psychologically. First, it is necessary to understand the structure of the MACD. The MACD is typically calculated by subtracting the 26-period exponential moving average from the 12-period EMA. The resulting value is called the MACD line. In addition, a 9-period EMA of the MACD line is taken to form the signal line. These two lines are displayed together on the chart. Investors make buy or sell decisions based on the direction in which the MACD line crosses the signal line. The upward crossover you mentioned refers to the MACD line crossing the signal line from below. In technical analysis, this is known as a bullish crossover. Such a crossover indicates that the downward momentum in the market has ended and an upward momentum has begun. In other words, the probability of the price rising increases. To better understand the logic behind this, think about how moving averages work. When the short-term moving average, 12 EMA, begins to move above the long-term moving average, 26 EMA, it shows that prices are rising faster in the short term. This indicates that buyers are gaining strength in the market and the trend may be turning upward. The MACD upward crossover captures this point and gives investors an early warning. When looking at price charts, points where the MACD makes an upward crossover often show the price rising shortly afterward. However, it is important to note where the crossover occurs. If this crossover happens below the zero line of the MACD, it often signals the start of a strong upward move. Because below the zero line, the short-term average is still below the long-term average, and the new upward momentum has just begun. If the crossover occurs above the zero line, it can be a signal that the current uptrend will continue. In your scenario, the price may already be in a certain support zone, and an upward crossover in the MACD would be a technical confirmation of a rebound from that support. In such a case, buyers would enter the market with more confidence. Large investors, or whales, in particular, closely follow such clear signals from technical indicators, as these momentum turning points are often the best times to make substantial entries into the market. From a psychological standpoint, MACD crossovers directly influence investor behavior. Many traders use this indicator signal in automated trading systems. Therefore, when an upward crossover occurs, not only manual buyers but also algorithmic trading bots start sending buy orders. This creates sudden and noticeable upward pressure on the price. Additionally, the MACD histogram provides important clues during upward crossovers. The histogram shows the difference between the MACD line and the signal line. Before an upward crossover, the histogram usually starts shrinking on the negative side, and with the crossover, it moves above zero. This shift shows that momentum has fully turned in favor of the buyers. In summary, an upward crossover in the MACD is a strong technical signal indicating the start of an upward movement in the market or the strengthening of the current uptrend. Such crossovers, especially when they occur at support zones, accompanied by increasing volume and confirmed by other indicators, offer high probability buying opportunities for investors. When used with disciplined risk management, this signal can contribute significantly to achieving substantial gains in investment portfolios.
Reaching a strong resistance zone at the top of a price chart is a highly critical situation in technical analysis because such areas are where both investor psychology and market dynamics are heavily concentrated. In the scenario you mentioned, if the price reaches the upper resistance, a 500% increase is expected. This is a situation that needs to be examined in detail from both the technical perspective and in terms of investor behavior. First, let's clarify the concept of resistance. Resistance is the level where the price has previously struggled to move higher. At this level, the number of sellers typically increases because many investors see it as a suitable point to take profits. Additionally, if the price has fallen from this level in the past, it becomes subconsciously coded in investors' minds as a drop zone, and sell orders tend to pile up. Therefore, when the price approaches this area, it is usually met with high trading volume. As you stated, if reaching this resistance level means a 500% increase, it implies that the current price is far below this level and that there is substantial upside potential. A 500% increase simply means the price rising to 6 times its current value. For example, if the price is currently $0.01, a 500% increase would bring the target price to $0.06. If the current price is $0.005, the target would be $0.03. Such an increase is possible in the cryptocurrency market, but it typically occurs as a result of major trend reversals or strong bull markets. Reaching resistance often draws investors' attention. Especially if there have been sharp declines from this level in the past, both buyers and sellers become active as the price approaches it again. Buyers may think that breaking resistance could trigger a new rally, while sellers might assume this will be another turning point for a decline and close their positions. At this point, the market becomes a battleground between opposing forces. The 500% target you mentioned is usually calculated in technical analysis using the concept of measured move. If the price has previously made a certain upward move and a similar pattern has formed again, technical analysts project the possibility of repeating that move to set a target. For example, if the price once rose 500% from a low within a certain time frame and similar conditions are forming now, such a target can be considered reasonable. When a price moves towards resistance, market momentum is extremely important. Momentum shows how strongly the price is moving. If momentum is high and buying pressure continues, the chance of breaking resistance increases. However, if momentum is weak, the price often faces sharp rejection when it reaches resistance. Such large upside potential is usually more common in low-priced assets. Particularly in low market cap cryptocurrencies, when trading volume expands rapidly from a low base, the price can surge quickly. However, it's important to note that low liquidity can also cause sharper price swings. When resistance is broken, the price usually makes a sharp upward move first, followed by a slight pullback to test the broken level. This pullback is known in technical analysis as a retest. If the retest is successful, meaning the price bounces back up, the rally can continue much more strongly. The 500% increase target often occurs in these successful breakout scenarios. Psychologically, this process changes investor perception. Breaking resistance levels often becomes a topic in market news and attracts the attention of new investors. This creates a fresh wave of buying pressure that fuels the price increase. Finally, the realization of a 500% increase potential depends not only on technical analysis, but also on market conditions, news flow, and overall investor sentiment. In other words, for this target to be reached, both technical and fundamental factors must align.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.